Hi everyone, my name is Corey Stackhouse and welcome to today's video where I'm going to explain to you 9 things that you didn't know that you could do with your health savings account. So let's dive in. What is a health savings account? A HSA is a tax advantaged account that's designed specifically for individuals with high deductible health insurance plans to help them pay for out-of-pocket expenses. So let's break down how they work. Eligibility. To be eligible and to open an HSA, your high deductible health insurance plan typically has to meet a certain number of requirements. Those requirements are going to be the minimum annual deductible for the policy. If you are a single male, if you are single in 2023, the minimum deductible limit is going to be $1,500. The maximum annual deductible and out-of-pocket expense limits for that policy cannot be any higher than $7,050 in 2023. Now, family plan, same numbers are going to be applicable, but the number is going to be doubled. So minimum annual deductible for a 2023 on a family plan is going to be $3,000. The maximum deductible and out-of-pocket expense for those plans is going to be $14,100. I put on here 2024 so you can see those numbers for upcoming years as well. For 2024, the single minimum annual deductible is going to be $1,600. The annual maximum out-of-pocket and deductible is going to be $8,050 for a single individual. Family plans again will double, $3,200 for a family in 2024 for the minimum annual deductible, and the maximum annual deductible and out-of-pocket expenses are going to be $16,100. Contributions. What are those? Those are going to be what you can add to your account. There are annual limits for individuals and families. 2023, anybody under the age of 55 can only contribute $3,850 per year. That is including their contributions and employer contributions. The maximum that a family could put away in 2023 would be $7,750. Now, if you are over the age of 55, there is a catch-up provision, which is going to be an additional $1,000. So for a single individual, if you're 55 or older in the age of 2023, you're going to have $4,850 that you could save annually as the most. A family plan can consist of, between all of the HSAs within the family, $8,750 in 2023. 2024, I put those numbers on here as well so we can reference those in the future if needed. The new annual maximum contribution for a single person in 2024 is going to be $4,150, with somebody who's over the age of 55 having an extra $1,000 they could save. Again, $5,150 is the most they could do. Family numbers, again, are going to be double. A family plan in 2024 can save $8,300. If they are over the age of 55, they can save away $9,300. That is how contributions and the limits work. Now, withdrawals. So you can take monies out of your HSA at any age. If they're for a qualified medical expense, it's all going to come out tax-free. That is very, very powerful. If you do not pull your money out of your HSA for a qualified medical expense, there is a 20% penalty plus taxes on top of those distributions. So before you decide to jump into a high deductible savings plan, I think you should probably consider what your current out-of-pocket expenses are and medical conditions relative to any potential savings you could have from looking at one of these plans and thinking about your future self, which I'll get into here in just a moment. Okay, so qualified medical expenses. What are those? These are the cost to diagnose, cure, mitigate, treatment, or prevention of disease, and the cost for treatment affecting any part or function of the body. This is going to include medications, doctor's visits, surgeries, and many other medical expenses. Over-the-counter medications and health insurance premiums generally are not considered qualified expenses, with some exceptions, which we'll get into as well. So tax advantages. Pre-tax monies that you are going to be what monies are put into the account. So you get a tax deduction every time you put money in here. It means you're paying less taxes in the calendar year that you're contributing it for. Again, you get to pull all that money out tax-free in the event you need to pay for a qualified medical expense. The third tax advantage inside of here is going to actually help us pivot into the first thing maybe you didn't know about your health savings account, is that you actually have tax-free growth on any investments inside of that account as well, as long as it's used for qualified medical expenses. So you can invest those monies for your later self. Fun thing with HSAs, you don't actually have to spend the money before the end of the year. I think a lot of people get that confused with flexible spending accounts and health reimbursements accounts. Those plans do tend to make you have to spend the money prior to the end of the year or have some restrictions on what you can roll over to the following year. HSAs, you actually do not have any requirements to take distributions at all inside of these until a later point whenever you want to, which is awesome. I ran an example here. If somebody's saving $300 a month, let's assume they're age 40 and they're wanting to retire at 65. If they do this for 25 years, they put that $300 a month into the health savings account and never need it, hypothetically, for their current medical expenses, or they have the money saved in their savings account if they had a deductible they need to meet or anything along those lines. If they averaged a 7% annual rate of return, they could have over $250,000 in that health savings account for a later date, which again is super, super powerful because you can use those monies to pay for the second reason, Medicare premiums. A lot of people didn't know this. There is an article that CNBC wrote earlier this year, back in February 2023. It talked about the cost ranges. It can be anywhere across the board for a family who is retired and 65 and older. It can range anywhere from $56,000 to $383,000 total dollars that you would expect to need during your retirement years to fund just your medical expenses, which that blows my mind. That is why, again, I like to talk about health savings accounts as soon as I can with somebody, because if you incorporate the investment piece and think about your Medicare situation in the future, this can be very, very powerful. Item to note with these, you cannot use these premiums to pay for the Medicare or Medigap policy, the Medicare supplement policies you purchase, although it can be used for Medicare expenses for Part B. I think in 2023, it's $164.90 a month. You can take those deductions from your health savings account tax-free as well, and for your prescription drug coverage that you have going on. That is the second reason, or second thing that maybe you didn't know about a health savings account. The third thing that maybe you didn't know is just as powerful: long-term care insurance. So I think there's a figure out right now. They say that 65 to 70% of 65-year-olds will at some point need long-term care help. So with that, why not consider using your health savings account to fund a long-term care policy, which you can do. As long as the long-term care policy is considered tax qualified, which means that the policy must be guaranteed renewable. They can't cancel on you. It can only pay for long-term care expenses, and it cannot accumulate any cash value inside of it. You can, again, use your health savings account accumulated funds to pay the premium for that long-term care policy. Also included in here what the average cost would be for a joint long-term care policy for a spouse, depending on the age. 55, you're looking at about $3,000 a year or $250 a month. Age 60, you're looking at $3,425 a year at closer to $300 a month. Lastly, if you wait until 65 to look into these types of policies in today's world, it's looking like a joint policy would run somewhere around, we'll call it $4,800 a year or $400 per month. That would get you a $165,000 benefit pool for long-term care with a 1% inflation rider. So that policy would grow over time with inflation. As we all know, 1% inflation is not reality, but that is what the cost would be to have an increasing benefit pool available to you. So long-term care costs are something you could pay for with that HSA, which is the third thing that maybe you didn't know. The fourth thing that maybe you didn't know was going to be ownership and portability. This comes up in my office quite a bit, actually. The HSA is actually owned by you. It's not owned by the employer. So you have free reign, whether you're still working there or not, to either leave that HSA where it is, or you can move it out elsewhere if you would like, even while you're working again. So why that could be advantageous: some employer-sponsored health savings account do not offer investments inside of them. You can use portability and move that money from your current employer HSA to an outside one without having any tax consequences or penalties. There's really two ways to do it. You could do a direct transfer from your current HSA to the new HSA that you set up and just send it from point A to point B. You never touch the money. Or the second option would be an indirect rollover, where you can cash in your HSA that you have with your employer, just take it all out at once, and then put it into a new HSA elsewhere. It would be coded as a rollover, so it would not affect your contribution limits or anything along those lines. But as long as you did that within 60 days, you could do that and not have any tax penalties or anything along those lines, and then have investment opportunities available to you. So talk with a financial advisor or do something on your own with that. But that is one suggestion I always mention to everybody that a lot of people are not aware of, is that you can actually move your HSA while you're working with your employer. Even though on 401ks and stuff like that, you normally cannot unless you're the age of 59 and a half or older and do an in-service withdrawal, but that's another conversation for another day. So that was the fourth thing maybe you didn't know. The fifth thing that maybe you didn't know about your HSA is that you can actually reimburse yourself at a later date. I kind of alluded to this earlier, to where you do not have a annual period that you have to spend your HSA monies in. You can let it roll over to the following year, so you can have compound interest and everything else like that. So you can reimburse yourself from a past medical expense, which is really cool. I gave an example here that somebody pays for a $500 dental procedure without using their HSA whenever they paid for that bill. 5 years later, they can reimburse themselves if they want to, as long as they've got that receipt. And if the IRS audited them, they have proof to show that that was a qualifying medical expense that I did take money out of my HSA for. You can do that. My wife and I have actually done this on a vacation or two in the past. So we'll have accumulated HSA funds, and throughout the years, we have these little dings of doctor's visits, co-pays, prescriptions, those types of things that add up. We'll reimburse ourselves all at once, so we have a chunk of money that we can then go book a vacation with or something along those lines too. So that's a strategy I like to mention to everybody as well. So that's the fifth thing that maybe you didn't know about your HSA, is that you can reimburse yourself at a later date, even years down the road, which is really cool. Okay, so the sixth thing that maybe you didn't know is you can actually leverage the HSA towards retirement spending too. Now, I mentioned you can use it for paying for medical expenses and long-term care expenses in the future. In the event you don't have those, let's say you're as healthy as an ox and you don't have any medical problems, which I hope, what you could do if you've accumulated a chunk of money in your HSA account is you can actually pull that money out after the age of 65 and just treat it like an IRA. So every penny that you put into that account now, whenever you pull it out, would be taxable if it's not used for a qualifying medical expense. But again, it's just like you open up a IRA way back in the day at the same time as this HSA, and they were both invested exactly the same. The performance was exactly the same across the board. They're apples to apples. That's your back door, assuming you did not have medical expenses, which is another reason why I can argue you ought to consider looking at a health savings account in your health insurance plan prior to even considering looking at IRAs and Roth IRAs. All right, so that was the sixth thing that maybe you didn't know. The seventh thing is going to be you can pay for your COBRA insurance premium. So let's say that you decide to change careers. I know a lot of that's been happening as of late. Whenever you want to stick on your current employer's health insurance plan, even after leaving, you have an 18-month window that you can do that. And most of the time, your insurance premiums are going to double or even go higher than that. I've seen quadruple in some cases, because the employer's health insurance plans, they're going to be covering at least half of your total cost of that premium every month. So what someone may come to find is if they were on a COBRA premium because they decided to change careers and wanted to stick with the old insurance because maybe the new employer doesn't offer health insurance or whatever it may be, they can use the HSA monies that they've accumulated tax-free to pay for that premium while they're on that COBRA insurance. Again, that's only an 18-month window, but it is available to somebody who's changing jobs or even retirees who are considering retiring before 65. Some of them consider waiting until they are 63 and a half so they can take advantage of COBRA premiums based on their current health conditions or whatever it may be. So that is the seventh thing that maybe you didn't know about a health savings account. All right, the eighth thing that maybe you didn't know is you can cover non-medical health related items. I kind of hit on this earlier to where you can take money out of your health savings account. If you're doing it prior to 65, though, I said this at the very beginning of my presentation, that there is a 20% penalty on those proceeds that you take out. Plus, you're going to owe taxes on them in addition to that. So I gave an example to where if a 40-year-old took $1,000 out of their HSA to buy a new laptop for themselves, they would pay 20%, so a $200 penalty plus income tax at whatever their income tax bracket is. Now, if we think back to how you can reimburse yourself for a future date, that would be a strategy that I would have mentioned to this 40-year-old at that time would have been, hey, do you have medical expenses you've not reimbursed yourself for from that HSA yet? Because if so, your $1,000 that you're wanting to pull out, some of that or all of it could be technically considered a qualifying expense because you reimburse yourself for a medical bill. Then you take that money to buy the laptop in that instance for. So just an example. But that is the eighth thing that maybe you didn't know about your health savings account. And the last and final thing is going to be you can actually fund your health savings account after the age of 65. Most people are under the impression you cannot fund your HSA after the age of 65, which is true for retirees, if they are on Medicare, though, they're not able to. So the example on where you could fund your HSA after the age of 65 is, let's assume you're 70 years old and you're still working. You can still fund that HSA because the employer offers that qualified health insurance plan, even though you are on Medicare. So that's a fun fact for a lot of people that they didn't know. That is the ninth thing that maybe you weren't aware of on side of this HSA. So before I end this video, I do want to give you a little disclosure. I am a certified financial planner and an insurance agent at Stack Enterprises that is my own firm. But this should not be treated as your personal investment advice. Please talk with your trusted financial advisor or tax advisor or attorney or whomever it is that you handle these affairs with to see if they're going to be applicable to you. But since I got that over with, the conclusion of this presentation is that HSAs are not just a savings account. I think that's what a lot of people think they are. They are very, very versatile, and they're very powerful tools that you can leverage for your financial well-being. If you found this video useful, please consider liking the video, sharing the video, and telling any friends or family about it, and sending them this video that way in order to hopefully provide some more value in their lives. And consider subscribing to the channel. We post videos at least once a week covering the topics of financial planning, investment management, Medicare, health insurance, tax planning, estate planning, the whole 9 yards. So look forward to my next video next week, and please feel free to reach out if you guys have any questions. My contact information will be below in this video. Have a great day. Thanks.